Good afternoon, everyone. To the folks joining us from the West, good morning and welcome to the 11th Annual Canadian Restaurant Investment and Leadership Summit. My name is Dimitri Mazur and I'm with CW Franchise Finance, your hosts for the event this week. I have the pleasure of being your virtual MC today and for the duration of this week's summit. Although we had hoped that this year would have been in person, we are virtual for a second year in a row. And I can say that we're all looking forward and expecting that next year's summit is back to in person. I know I do, but I can indeed say it is a nice change to be wearing a collared shirt instead of the same t-shirts I've been wearing for the greater part of 2 years. So let's all cross our fingers for next year. Before we get started, I want to go over a few housekeeping items given the virtual nature of the summit, so you know how to participate in today's session, but also throughout the week. So do please bear with me. First of all sessions, networking, and the exhibit hall will take place directly on this virtual platform that you are using. And you'll be able to access the platform all week long, not just during the actual sessions. We hope you find the platform easy to navigate, but we also have put together a detailed user guide, which you can find in the Help tab on the left-hand side of your screen. We also recommend that you set up your personal profile in the Profile tab, and we encourage you to visit the exhibit hall and the networking areas throughout the week so you can connect with other attendees, sponsors, and other partners. For today, we have an hour and 15 minutes booked for the Foodservice State of the Nation. You'll have the opportunity to submit questions throughout today's presentation by typing them into the Q&A area of the right-hand side of your screen. And should we not get to all the questions, we will follow up with you after the event. A reminder, the session is being recorded and we will send out links next week for your reference. Always of large interest, later today we will be sending out an email with a link to download a copy of the 2021 Canadian Chain Restaurant Industry Review, which we produce every year along with the NPD Group and fsSTRATEGY. This document provides essentially an overview and analysis of the overall state of the industry in Canada. And in that same email, there will also be a link to a feedback survey about today's session. We do appreciate and ask that you please take the about 30 seconds to provide your feedback, as it does help us greatly shape future events. And finally, after today's session, there will be roundtable discussions taking place in the networking tab. Up to 25 people can attend each roundtable discussion. If the spots are full, we will be hosting the same roundtables again tomorrow after the CEO panel discussion. Now that the housekeeping is out of the way, let's talk about why you're all here today and joining us this week. So since 2010, CW Franchise Finance has been hosting the Canadian Restaurant Investment and Leadership Summit, making this our 11th annual event. And again, although we didn't predict we would still be virtual this year, it was important for us to continue with the summit and to help bring the industry together, providing an opportunity to connect, engage, and learn from each other. There's no denying that the last 18 plus months have been tough on the industry and everyone involved, but there's been a true sense of camaraderie and support with one another across Canada, figuring out what is the new normal and navigating the ever-evolving landscape as we truck through to the so-called other side. So over the next 4 days, we'll be hosting 6 sessions, the roundtable discussions and the virtual exhibit hall and networking area, which will be open throughout the week for you to connect with other attendees. We will be kicking things off each day at 1 p.m. Eastern Time. Before we get started with today's presentation, I'd like to take a moment to thank all of our sponsors for their support and participation with this year's summit. We could not have done it without them or made it complimentary for everyone to attend without their support. So our platinum sponsors, Chicken Farmers of Canada and Cisco, gold sponsors, 7 Shifts, Attitude Marketing, Castles, Garland Canada, and Uber Eats. Silver sponsors, Coca-Cola, Dairy Farmers of Canada, Interact, and Sodos. And our bronze sponsors, Foodbuy, J. Ross Hospitality Recruiters, Kitchen Partners, Measure Up, Osler Dash, Smooth Commerce, SBLR, Weeks Construction Group, and XTM Inc. We also want to thank Menu Magazine and Restaurants Canada for being our media partners, and the NPD Group, our premier research sponsor, as well as fsSTRATEGY for their contributions to the 2021 Canadian Chain Restaurant Review, again, which you will all receive a link to later this afternoon in the follow-up email. Finally, we'd like to again say thank you to Chicken Farmers of Canada for sponsoring today's session. If you're interested, you can join the roundtable discussion for a virtual farm tour and live Q&A directly following this session in the networking area. And now let's dive into today's presentation, the Foodservice State of the Nation. This is the 7th consecutive year CWB Franchise Finance and the NPD Group have come together to deliver this presentation. It is always jam-packed with relevant information and insights on the industry, and I expect nothing less this year. So please join me in welcoming Jacob Mancini, AVP Restaurants and Breweries with CWB Franchise Finance, and Vince Sgabellone, Industry Analyst, Canada Food Service with the NPD Group Canada. Over to you guys.
Excellent. Thank you, Dimitri. Much appreciated. Good day, everyone, and welcome back to our 7th annual Foodservice State of the Nation address. So it's great to be back here for this presentation, and obviously great to have Vince joining me again this year. And so, Vince, welcome back, and thank you again for being here.
Well, thanks again for having us here. Glad to be back in front of the industry and on this virtual stage with you, Jacob. So tell me, Jacob, when we were here together last year, we promised everybody at last year's conference a new normal. And just when is that new normal going to kick in? I feel like we've let down our participants.
Yeah, well, you know what, Vince, you're right. We did, right? In our last slide last year was all about how the pandemic was going to shape our industry going forward into this new normal. And here we are a year later, and it really doesn't feel all that normal, right? We've had 2 lockdowns, a ton of uncertainty, plus, of course, some growing optimism. But all that's really done is left us with an industry where nothing really does feel normal. And so I think a great place to start this year is maybe a dive into why things don't quite feel normal yet. And for me at least, a great place to start is with the economy, right? Which has had a really inconsistent recovery so far this year, and quite frankly been anything but normal. So maybe a couple of highlights to touch on really quickly. The labor market has been steadily recovering since last summer of 2020, but it's still about 1.5 points off its previous low. But fortunately, I guess based on current trends and in sort of the reopening schedules, the thought is that we should be close to that pre-pandemic level by the end of this year. Inflation is an ongoing issue, and last month the consumer prices grew at the fastest rate in over 18 years. And while supply chain issues remain a concern, I think the overall consensus seems to be that a lot of this is a function of pandemic policies and restrictions and consumer behavior, and hopefully that stuff will fix itself in time instead of requiring some government intervention. But some of the above is tied to a growth in disposable income and savings that we saw for a lot of 2020, thanks to those support programs and transfer payments, plus sort of a lack of spending options, obviously. But as things have reopened and people have started to get back out there and use their money, 2021 does or has seen a bit of a slowing in disposable income and a pretty aggressive movement in towards those pre-pandemic saving levels. Obviously, the housing market has been in a historic growth phase lately, right? And it's a perfect combination of low mortgage rates plus growth in income that's really led to this booming demand and 8% growth in mortgage lending, which is the highest rate of growth in over a decade. And then meanwhile, mortgage deferrals and support programs, have kept supply of houses low, and of course, and sent prices skyrocketing to a point that the year-over-year growth is as high as it's been since the 1980s. A couple other, quick comments on the economy. Sign of positive economic outlook, both for households and businesses, is that borrowing has returned. And in the second quarter, loans in both those categories grew for the first time since the start of the pandemic. And so while they're still lower than pre-pandemic levels, this increase does sort of signal hopefully some positive business sentiment and overall sort of may lead to some growth and employment. And last on this issue on the economy, that expected rise in defaults and insolvencies that typically occur in a recession haven't happened. And in both cases, These insolvency levels are actually lower than they were in 2019. This will likely change as these support programs come to an end, and I suspect we're going to see some correction on this in 2022. Another reason, Vince, I think that we've seen, or we've struggled a bit to hit this new normal in this restaurant industry, is that there hasn't been consistency in what owners and operators are predicting is going to happen and what's important. Just look back at the last couple of CEO surveys that have been done for this conference, and I think that illustrates the point perfectly. So between last year and this year, what we predicted would drive the industry forward has completely changed. This year, the top 10 includes 2 brand new entries that weren't even on the radar last year. And what was most important last year is not even in the top 5 anymore. So technology, as you can see, is the only sort of predictive, consistent component, which I think obviously highlights how important and relevant that's been before, during, and likely after this pandemic. But everything else, reiterates the challenges in defining a new normal, right? Our industry outlook has changed significantly in the last 12 and 24 months.
Absolutely, Jacob. But, it's nice to see there is some positivity in the market right now, which is certainly in a much better spot than we were at this time last year. So our CREST industry tracking here at the NPD Group over the last 2 years, I can see why we have some of that positivity. The data indicates that traffic gains over each of the last 3 months are hovering at about -15, -16% versus last year. And that leaves it at just about 4% below where we were 2 years ago. So we're inching closer and closer back to that old normal, even if we haven't quite figured out yet what that new normal is going to look like. So looking at this another way, the Canadian commercial food service industry lost about 2 billion visits, or $10 billion, in the first 12 months of this crisis. Since March of this year, just over 1/3 of that has returned. And this return has accelerated greatly since June, when restrictions began to lift across the country. So clearly, consumers did exactly what they told us they were going to do in our surveys during the pandemic. They began returning to restaurants in person as soon as they were permitted to do so and felt safe doing so. Much more on that a little bit later. Now, double-clicking on the traffic trend curve, we can see that each of the 2 restaurant segments, the full service or FSR segment and the quick service or QSR segment, behave very similarly. The difference is that the FSR curve dipped much, much deeper in the early days of the pandemic. But the segment posted triple-digit growth earlier this year, and by the end of the summer was easing its way towards recovery. Meanwhile, the QSR segment has already returned to 2019 revenue levels, at least on a month-over-month basis, in the last 2 or 3 months, even though traffic is still trailing those historical levels. Now, unfortunately, there is still a lot of lost ground to cover in the entire industry. So a couple of good months does not necessarily mean that we've reached that new normal just yet. So what is that going to look like for the future? Will things ever be the same? Will they be better, worse, or maybe just different? Well, Jacob and I are going to try to answer some of those questions for you right now during our presentation today. And we're going to give you hopefully some of the information you need to start figuring out the rest on your own. And we're going to do that by taking you through a day in the life, or more appropriately, a typical day in our lives. We're going to demonstrate for you what is going on in the food service market today by letting you follow along with me and Jacob as we go through our everyday routines. Along the way, we're going to highlight how our seemingly simple and routine activities throughout the day are actually an indication of a lot of the trends that are helping to shape our food service industry landscape. So follow along as we take you through a journey of shifting consumer behaviors, an evolution of the way in which we all interact with restaurants, the impacts that this is having on restaurants and the real estate market, and all of which is changing by the minute as we continue through this COVID pandemic.
Excellent, thanks, Vince. So, let's get started in a day in our lives. And more importantly, a day in our lives with our cooler and younger looking avatars. So, for my day at least, after 3 lockdowns starts with, sending my kids back to school and finally getting back to a morning routine that feels kind of like what it used to. And it doesn't feel like I'm the only one really returning to that normal commuting activity and behaviors. With kids back at school, people are again jumping back into cars and trains, subways, and even airplanes, as they start to sort of travel for work again. So with the kids out of the house in our country in this reopening phase, we are getting a lot closer to our older routines. But it does raise the question, how far we are along that, and are we there yet? And the survey data from the summer suggests that we're continuing to see a shift back to some of our former routines, but that these routines are going to look a little different, especially in the immediate future. 90% of parents expected their kids to be in school this year, and fortunately that's proven to be true. But over 30% of those same parents didn't expect that they themselves would return to an office this year. And in addition, another 25% of those parents thought that they were would be back, but in some kind of a hybrid form, so not a full-time office or work experience. Before I get moving, I want to stop and grab a coffee, which probably means hitting up a packed drive-through. And as I'm in this line, I can't help but notice just how impactful that this concept has been in the last 20 months. And throughout the pandemic, drive-throughs really have been king. And not surprisingly, of all the revenue channels, it saw the biggest bump in percentage traffic over the last 2 years. And it's not just that traffic bump that I think is important here, right? Drive-throughs and by extension that frictionless experience have really influenced store design and real estate selection and the integration of technology. And we hear almost daily from large international brands and small brands that are touting that they're the restaurant of the future, and it's always based around an off-premise digital strategy. And even in my neighborhood in the last 6 months, I've seen a QSR concept add a drive-through. And another QSR concept that couldn't do a drive-through added 2 walk-up takeout windows. And also, before we leave this, it's not just the operators either focused on the drive-throughs, right? It's, we hear from developers and landlords on how important this is from a discussion about real estate. So much to the point that, in fact, you hear these stories of secondary malls or plazas that are getting turned inside out to accommodate drive-through and takeout options. So essentially reducing this rentable space, but maximizing tenant quality and the rates that you can get by providing that option.
Yeah, Jacob, I have to agree. Your observations about the morning drive-through and the morning rush couldn't be more bang on. So our data shows that morning meal was in fact the hardest hit of all the day parts at the start of the pandemic, losing the most visits and shrinking by close to 20% last year, or about 400 million fewer visits. Now, this resulted in a drop of over 300 million servings of morning coffee through commercial restaurants. But the return to our morning routines, whether it's dropping the kids off at school or heading to work or both, just like you, has really resulted in a partial return of this morning meal day part. Mornings have long been the largest day part in the Canadian food service landscape. That's gone on for many, many years. And despite the disruption, it has remained through the pandemic as the largest. So as more and more people return to the office, we can expect that this morning meal is going to bounce back even faster. So tell me, Jacob, when you went through the drive-through, did you place your order on a mobile app?
Yeah, I've found myself doing that more and more, because there's something that's, I guess, about the simplicity of getting my order ready, before I even leave the house, that really has made the commuting process just a little bit easier.
Well, you're very much in good company there, Jacob, because this slide really reinforces why the CEOs in our survey are thinking about digital technology, because digital is where the future of food service is going. Now, last year when we were on this virtual stage, you and I spoke about accelerated trends, and the fastest growing of those trends at that time, before the pandemic, during the pandemic, and I'm confident along with all the CEOs, is going to be digital. That is going to be the biggest driver of food service industry growth for years to come. After growing by triple digits last year, it's up another 67% this past 12 months. Digital share of orders has risen from about 4% share to 15% share, and actually peaked up at about 20% during the height of the lockdowns. Now, this is a trend that is spanning all access modes, all day parts, all restaurant segments, and all age cohorts. Digital apps are by no means just for the millennial and Gen Z generations any longer. And now, nothing goes better with your morning coffee than loyalty points. So loyalty program participation among morning restaurant visitors has topped 50% against an all-day long average of about 32%. And why do people participate in loyalty programs? Because they like a good deal along with their coffee. And about 1/3 of all loyalty program transactions includes a deal of some sort. So that might be a coupon or a daily special or a combo discount. So as a recent example of both of these phenomenon, McDonald's US recently rolled out a new app-based loyalty program. and they signed up more than 12 million subscribers in just their first few months. And one of the ways they did this was by offering something for free, a free McFlurry or a free small cone. Now, I know that McDonald's Canada is testing a new loyalty program in parts of the country, so I'm guessing you can probably expect to see some changes in this market as well as the coffee wars continue to rage on. So in short, loyalty programs, digital ordering and dealing, and of course coffee, they really do go hand in cup. All right, so moving on with our day, while Jacob was battling traffic on the way back to his office, I made it to my kitchen for my morning coffee and then headed to my home office. And I wasn't alone, so to speak, in my commute either. Our friends over at Nielsen tell me that dollar sales of roasted ground coffee are up 15% since 2019, and that includes an additional 5% gain this year over last year's pandemic peak. There's really no sign that these sales are going to diminish anytime soon, especially when you consider how much stuff Canadians have been buying for their home over the past 18 months, including a huge assortment of kitchen electrics and gadgets. We've been stocking up for the long haul, and it continues to this day. And I can certainly count myself among the masses, and if we were in a live room, I would have asked for a show of hands, but I've certainly purchased a number of new gadgets and electrics for my kitchen over the last year or so. Now, just like 1/4 of all Canadians, this has allowed me to become a stay-at-home barista. So this trend has helped to fuel specifically a $33 million increase in coffee maker sales in this year alone. This is now into the second year of our pandemic. So it's the fastest growing segment of this market actually is the high-end machines costing over $200. Now you heard Jacob earlier talking about higher disposable incomes, and this is one of the ways that it's manifesting itself. But of course, it's not the coffee that's keeping us at home, it's the work that's keeping us there. Looking a little further into the future beyond 2021, we can expect that many workers do not expect to return to their office full-time after the pandemic concerns have eased. About 30% of the workforce worked from home some of the time pre-pandemic, and that is expected to rise to about 46% when this is all over with. That's a jump of half. Now, according to Stats Canada data, there's about 20 million people in the workforce. So this translates into a potential 3 million fewer people leaving home every day. Now, for those listeners who depend on this morning coffee traffic, I can reassure you to some extent because currently about 1/3 of all restaurant coffee is consumed back at home. And this is up from about 1 in 5 before the pandemic. So it looks like a lot of coffee consumers really still do continue to enjoy their out-of-home coffee habits. Now, when I'm ready to leave my home during the day and I just need a little change of scenery from my home office, it's nice to know that there are other places for me in my neighborhood to go. For example, restaurants who are looking for new revenue streams are starting to open up their dining rooms to new uses besides just dining. These co-working spaces in restaurant settings, it's not a new concept necessarily, but it's another trend that has had the potential to explode as the pandemic continues. And it affects consumers going back to their regular office routines. So FlexStay is one of those examples, and it's a Toronto-based startup that is designed to connect restaurants with people who want a flexible workspace. It's an app-based, and it helps people to find those workspaces in underutilized restaurants or coffee shops or retail stores. And really, their participation has just skyrocketed this past year, as you might imagine. Now, Jacob, what's your morning routine looking like back at the office?
Well, like you, Vince. I mean, I'm jumping around between emails and phone calls and meetings with people, and as you can imagine, for me at least, a lot of my conversations center around topics like finance and investment and growth. And this year in particular, especially recently, there's been a lot more talk about what's been happening and hasn't happened in some of those areas. And I like to sort of refer to those as my sort of what's going on here questions that sort of come across every now and again. And one of those what's going on here questions that comes out a lot is what's happening with restaurant real estate. And I think, first of all, this is another example of how hard this last year has been to predict. Because a year ago in our surveys, the biggest opportunity for restaurants was growth. And it was all going to be driven by all the site availability and sort of these tenant-friendly rates that were supposed to be out there. So we fast forward, of course, to today, and that's not the case. And instead, you've got supply, low supply, and rental and resale rates that are in a market that are white hot. And a lot of this has to do with those deferral programs and subsidies that have kept vacancies and closures at levels nowhere near anticipated. And then because of that, that support and the lack of pressure, landlords have been, for the most part, been kept whole, and inventory has been limited. And if you look down even further, so in suburban markets where we know that they've been solid, this also means that anything of quality that comes up is snapped up at market rents. And what's left is space that isn't really built for the way that operators and consumers want to use restaurants these days. And then on the flip side, even in urban markets where challenges have been well established, there's still a lack of vacancy, and we've seen landlords really take a long view of this market, right? So even new and existing stuff that comes up, they're really holding on price with this bet that traffic and quality is going to return in 2023 and beyond. And so my closing comment on real estate is that it's going to be interesting to see how this all develops, right? So CEOs still view growth as a key component to this recovery and have capital set aside to do it. But again, the market and consumers, I think, are really going to dictate what happens here. Because if sites that come up don't mesh with how we use consumers, use restaurants these days, then we could be looking at a real extended shortage of these good locations. So on the topic of real estate, also worth, I think, checking back in on hubs and hub dining, right? Because this is a really relevant concept that it exists everywhere across the country. Malls and transit and travel hubs, tourism areas, and event complexes and office buildings, all have big dining components associated with it. And while I think we expect there'll be some strong recovery in a lot of these areas, the data does suggest that one area in particular might continue to struggle, right? And that's the office environment. Toronto's second quarter vacancy rate was 10%, which was up a full point over the previous quarter, and just shy of the vacancy rate in 2008 when we were in the middle of sort of a worldwide recession. And over and above that, current estimates for occupancy downtown suggest that it's as low as 20 or 25%. So it all begs that question of what's going to happen with all this space. And I think new and well-positioned real estate is going to be fine, but it does leave some B and C level real estate out there. And for hub dining to return in these core markets, something has to be done with that. And I also think that this pandemic really showed that downtowns, didn't offer enough diversity. And so I think the answer is repurposing that space to achieve that goal, right? And this could be more housing, and not just condos, but things like senior complexes and student residents. And then by extension, more services to support that residential base. And when I think of those services, things like distribution and logistics centers, so urban core focused, make a lot of sense, as do grocery stores. And on one topic on grocery that I really think is really interesting, it's caught my attention, is this idea of dark grocery, which is what you think it is, where you've merged sort of that dark kitchen idea with a grocery store and sort of offers a completely digital third-party delivery experience. And I believe it bears watching because with a growing residential base, this is an example of a concept or an idea that could take large chunks of lower quality real estate and still thrive in the downtown urban market. So with my morning meetings done, it's time for lunch. And, speaking of lunch and speaking of hubs, being back in an office complex also means a return to my old lunchtime routine, at least sort of, because more than my morning commute and more than my coffee routine, my lunch experience does really feel a little different than it did before. And it wasn't uncommon to have a client lunch or group lunch with some of my colleagues in the office. And in all cases, this tended towards a full service experience because that's where we went to get business done or just to catch up. And this just doesn't happen anymore. And so when I'm in the office now, it's more likely, like I did today, that I'm going to run down and grab something from the deli downstairs and bring it back. Although even that experience highlights some of the problems that we're facing in this industry, because with empty parking lots and empty office towers, what was once a 5-person operation with lineups is now really down to 2 with low traffic. And so again, all this begs this question of what's happening with lunchtime trends.
Well, Jacob, the data confirms that the lunchtime trend is exactly as you describe it. Lunch has been the hardest hit in terms of percentage declines during this entire pandemic. It's also been the slowest to return. And this is all about the on-premises visits, which have largely evaporated. FSRs are the most impacted by this trend, since the QSR segment has already been very well positioned for off-premises anyway. In fact, I'm seeing QSRs that aren't even bothering to reopen their dining rooms, at least not yet. Instead, they're just quite happy to continue servicing their customers off-premises only. Meanwhile, it is good to see some gains in off-premises lunch going through those FSRs. It took them some time to figure out how to serve their menus through off-premises channels, but now that they're fully engaged in the takeout business, they are making the most of it and trying to recapture some of those missed office lunches one way or another. All right, now turning to my lunch, while Jacob is eating al desco in his office, I raid my refrigerator for lunch. And like many Canadians, I've been spending more and more on groceries this past 18 months. And this is not necessarily a statement about food inflation. Once again, turning to Nielsen data, they are reporting a huge increase in food sales through grocery and all channels since the start of the pandemic. 2021 continues to be up, even after a record 2020. So chances are I'm going to find something to eat in my refrigerator for lunch. Now, I will say, though, that the only thing at lunch that's better than a refrigerator full of groceries is one that's full of restaurant leftovers, all ready to go. For the restaurateurs listening in today, you really need to think of ways to get more of your food into your customers' hands each time they visit. If you're delivering to them, encourage add-on orders for the next day or for another meal later on. When customers do come to visit you in person, don't let them leave your restaurant empty-handed. Encourage takeout orders that they can use to stock the refrigerator. Meal kits, discounts, or deals, or anything to get that extra to-go order. Anything to pad it, because you know that restaurant visit frequency has been way down lately, and you won't be seeing that customer again as soon as you might have hoped or might have pre-pandemic. So make sure you get every dollar out of every customer on every occasion. Now, from time to time, one of the things that us work-from-home people miss is the opportunity to treat ourselves to a restaurant meal at lunch in the middle of the day. And that's where delivery comes in. Once again, restaurants have figured this out, and they know that if their customers aren't necessarily coming to the restaurants, well, let's just bring the food to them when they're working at home. I know I've been happy to take part of this on this trend on many occasions, as have many others on this call, I'm sure. About 100 million additional restaurant orders have been delivered to homes at lunch in the past year. Now, this represents 4 out of 5 of all lunch deliveries, which is up from about half in 2019. Now, as you just heard from Jacob, diners are not returning to restaurants at the lunch day part to the extent they could be, even if they are working out of home again. So this represents a challenge, but also another opportunity for restaurateurs. The office lunch delivery. Restaurants have done such a good job of reaching people in their homes with delivery over the last 18 months. So they really need to just keep that momentum going as people return to the office. And this represents another opportunity to get those incremental delivery occasions. Now, as long as you're sending food home, consider ways to get Canadians using all of their new gadgets that I spoke of earlier. Sales of things like air fryers, toaster ovens, and electric grills have all seen huge, significant growth in the Canadian market. And as Canadians are looking to find those lunch alternatives working from home, you know, this is an opportunity again for the food service industry to make sure that everybody is adding some food service sourced food onto their work from home lunch menu, and make sure the food isn't coming entirely from groceries these days. Now, after a long day of working at home, you know, it's time to treat myself with a little afternoon snack. So I head out for a walk to my favorite coffee shop. And taking a walk through my Midtown Toronto neighborhood, I am really struck by the number of closures. Now, I've seen some chain locations that have shut down, as you know, even the big brands and their franchise partners have taken the opportunity to close some underperforming units during this time. But in my neighborhood, like most neighborhoods in Canada, it's really all about the independents that have been the hardest hit. According to our recount census data, about 10% of these independent restaurant operators closed permanently in 2020. I'm sure many more have closed since, and data from Restaurants Canada suggests that even more will close as most continue to struggle financially, despite the somewhat steady return of customers. Now, the most interesting stat on this chart, though, is that for the first time since we started tracking this data about 20 years ago, there are now more chain restaurants in Canada than there are independents. This trend towards chains has been going on for many, many years, but 2020 is the year that the chains overtook the independents. And this has tremendous implications for the industry. Food suppliers and food distributors will all have to change the way that they go to market. Real estate developers, restaurant workers, and of course, consumers will all be impacted by this accelerated shift in the restaurant landscape. Now, despite all these closures and the bad news that brings, the news is not all bad when it comes to restaurant development, as you heard Jacob speaking earlier. So 2 QSR segments, for example, actually added doors in 2020, and while a third held steady. Mexican and global cuisines are growing or holding steady, and this is really a testament to a number of macro trends that we've been tracking in the market for quite some time. First of all, we've got the ongoing influx of immigrants to Canada, who bring with them their native cuisines and also a tremendous entrepreneurial spirit. A growing demand, especially among younger consumers, for these global flavors and food exploration in general. And finally, we see the rise of small chains. Across these 3 segments pictured here, there's only a handful of brands with more than 100 locations. The growth is coming from smaller up-and-coming brands. Now, Jacob, you're going to be highlighting some of these up-and-coming chains later this week in one of the other sessions, aren't you?
Yeah, that absolutely, Vince. In fact, the CEO panel tomorrow, right, is really focused on that exact conversation. You know, how some of these smaller creative brands resonated during the pandemic, and then how they've used and leveraged that creativity and that innovation to grow and maintain relevancy. Pardon me. But before I kick it back to you, you know, with all this talk about segment growth and unit contraction and traffic trends, you know, this might be a good time for me to interject with maybe another "what's going on here" question that happens to come out a lot, and that's what's happening with consolidation and M&A activity in the space. And for anyone who knows me, you know, this is an area I've been pretty vocal about for the last 4 or 5 years, and I've long predicted an explosion of M&A activity. Right, the influx of institutional money, deeper management, slimmer margins, and just challenges with growth in general, all pointing to this happening. But yet here we are, you know, 4 or 5 years later, and 2 years into a pandemic, and you know, we've seen a little bit of this, but it's nowhere near, I think, where I or maybe others thought it would be. And you know, I do think it will happen, and it just requires the right market dynamics to do that. And very similar to that real estate discussion, you know, there's been a lack of financial pressure on operators, and often it's that financial pressure or that risk of bankruptcy that motivates these transactions to happen. And over top of that, you know, this pent-up demand and disposable income that we've been talking about here, you know, has really driven sales and profitability, you know, to levels that I think were unimaginable at the start of this pandemic, and possibly distorted valuations as a result. Because buyers and sellers both have a positive outlook on recovery, but a very different view and a pretty significant gap between, you know, what performance is going to look like and how to evaluate it. And this is also an area we're going to get into later this week on a panel. But I believe as subsidies go away, as sales sort of normalize, and with all that additional debt that operators have taken on through this pandemic, I think some of these financial pressures will come back, and they're going to spark some sort of new and interesting kind of discussions and probably a lot of activity. But anyways, back to you, Vince.
Well, thanks, Jacob, for that additional perspective on the real estate market. That's fascinating to look at what we think the future is going to look like. In the meantime, what we see happening because of this shift in the chain and independent dynamic is this overall shift in traffic towards the chains, as you might have expected. They now represent 4 out of every 5 restaurant visits in the market. But not so fast. Independents that were the hardest hit during the early days of this pandemic, you know, they didn't have the off-premises infrastructure, they didn't have the marketing financial support of a big brand behind them to help them out, and many were not as digitally engaged as they needed to be. But you can't keep a good restaurateur down for long. They've been coming back faster and stronger after each wave of lockdowns. In the summer of 2021, they bounced back to capture their largest share of summer traffic ever at 22%. And this dollar and traffic trend versus 2019, they're actually outperforming the chains for this 3-month period. So to put this into some context for you, I just reported a few minutes ago that 10% of independent restaurants closed in 2020, and yet for the quarter, their dollars are down by just 1%. So this means more volume on average for those who have managed to survive during this crisis thus far. Now, sure, it's just 1 quarter, and revenue does not necessarily equal profits. And as we heard from Jacob, hub locations continue to be hard hit by all of this change in consumer habits. But this is quite possibly the shape of things to come. A stronger, more resilient breed of independent and small chain restaurant operator is really staking out their claim against the big chains and helping to define what the future restaurant landscape is going to look like.
Interesting. And Vince, speaking of that independent bounce back, I'm wondering if during your afternoon wandering, like if you're seeing any kind of new or interesting concepts that are popping up in your neighborhood. Because for me, I think for some operators too, especially smaller ones, it's been interesting how they've been adjusting their store designs and their layouts to facilitate, more of a multi-channel approach to revenue generation. And, the Grocerant is an example you might have come across, Vince, in your walks. And it's exactly what, you think it is, right? And this is not a new concept, but it's definitely picked up steam since the early days of the pandemic where, operators used grocery as a bit of a means to drive some incremental sales. And I think some of that never went away. Italian operators, have always, embraced this concept. And you see a lot of that here in Toronto as an example, where some have merged commissary with a restaurant and a grocery store to sort of offer a more well-rounded experience. But we're also seeing it kind of pop up in some different cuisines, right? So, you can find a neighborhood snack bar concept in Vancouver, for example, that has sort of a whole general store vibe on top of its food offerings, and therefore sort of, creates a dual purpose for the neighborhoods that it operates in.
Well, absolutely, Jacob. I am definitely seeing a lot of different variations on this Grocerant theme across my neighborhood. Not to mention the bottle shops with restaurants selling beer, wine, and spirits to go. So anything they can do really to boost their sales volume during these very unusual times.
Yeah, absolutely. And, here's another one, another neat example I came across recently about sort of monetizing your space. And that's by sort of taking underutilized kitchen and dining room areas and using them as sort of an incubator to promote and support others. Kind of very similar to what you see in the tech industry an awful lot. And this one sort of caught my eye, a location in Toronto that opened up its space to bring in, I think, 4, intriguing but startup virtual brands so that they could sort of work out on their concepts and kickstart themselves into self-sufficiency. So, obviously a twofold benefit there. Obviously, it opens up a source of income, but also gives something back to the industry and supports something kind of new and interesting.
So, Jacob, tell me, while we're in meetings all afternoon, do you know what your kids are up to after school?
Yeah. I suspect, because they've been doing this an awful lot recently, they're probably at a convenience store, which for some reason seems to be where they want to spend all of their time these days.
Yes, all of their time and all of your money, Jacob. I think you're absolutely right. They are going to the convenience store along with all their friends, or they're going out for pizza, or they're going out for ice cream or any manner of afternoon snacks. The under 18 cohort has really been helping to sustain this part of the restaurant industry during this time of the day, that afternoon snack day part. So while parents are sheltering at home, kids' afternoon activities, as we know, have been cut. Their part-time jobs have evaporated. Malls have been closed for so long, although they're all reopening now. So kids were just hanging out and spending their money and their parents' money wherever they were able to congregate. And a lot of that was quick service restaurants and, of course, convenience stores. So this also explains why the afternoon snack day part has really performed so well. Not to mention sales of ice cream and specialty coffees through any sort of restaurant channel. Now, more than half of all parents are planning to return their kids to some of their afternoon activities within the next couple of months. Now, this number is much higher than parents and individuals who are planning to return to travel or to work or to indoor shopping malls, for example. So clearly parents are valuing these after-school activities as an important part of their kids' health and development, and possibly their own as well, which means that we can expect some return to the rushed family meal in the months to come. So for those who cater to these families, get ready. As activities pick up, there's going to be more of the evening drive-through visits. More meals at home will begin to shift back to those off-premises visits. But in the meantime, it's back to you, Jacob, for the next time in the day.
Yeah, and that's that's 6 o'clock, Vincent. So time for me to head home for dinner. And listen, I could go to the grocery store and buy something to cook at home, but with all of this convenience out there and all these options, I'm not even sure why I would do that, because I can literally get whatever I want, when I want it. And it seems like those options for eating at home just keep growing and growing every day. And, first of all, I think it's important to ask just how important dinner at home has been through this pandemic. And quite frankly, dinner has had a massive impact and played a critical role in really sustaining this industry. And in particular, family dinners have been key. And turns out that just like that growing snack category, Vince, you just talked about, kids have also played a really important role in that. And this is a great data point that speaks to that concept. Ordering dinner at home used to be heavily skewed towards adults eating on their own. But in the last 18 months, ordering dinner for the whole family has become a lot more important. And we've seen it grow by over 5 points during that time, which is really not an immaterial change given how structured and regimented our approach to dinner has historically been. So you can't talk about the concept of eating at home without talking a bit more about third-party delivery. And I know obviously a lot of you have come here today for insight and data on that topic, and maybe just how big that market has become. And so I think for that, Vince would be happy to share the answer. Or not. So maybe we're not going to get the answer from Vince right now, but what we do know is that this segment has changed this industry forever, and not unexpectedly, it's also a space that's changing daily, right before our eyes. And I just wanted to highlight a couple of examples of some of this change. After years of startup and organic growth, we've finally seen some consolidation in this space. Uber's $2.6 billion takeover of Postmates, or Just Eat's, $7.3 billion purchase of Grubhub, are sort of two examples of players consolidating, in order to get some better share and obviously better margins. We've also seen some integration between aggregators and tech companies that are paying dividends. I came across, Toast is a restaurant tech company that went from being really on-premise focused and almost collapsed at the start of the pandemic, and has now transformed itself into this, sort of digital ordering payment technology company, and as a result has been valued at, at over 20 billion in such a short period of time. We're also seeing a point where we're now seeing aggregators of the aggregators, which is something that we've seen for years in the hotel and the airline space, sort of like that Trivago example. And now you have Food Boss, which is a company that pulls from all the delivery companies and compares, who is offering the best deal in each neighborhood. And lastly, I really love this one. Aggregators are really getting creative with some of their partnerships. So, take Las Vegas as an example, where Grubhub and Resort World, did a deal where all the off-premise F&B on the resort is now managed by them. And then, that means things like room service, or ordering by the pool. Guests instead, just open an app and can order from any restaurant on site, and have it delivered to wherever you are, right? In your room, by the pool, or even quite honestly, probably at the tables as well. So another really important storyline in this discussion too of off-premise has to be, of course, the dark or ghost kitchen phenomenon, and by extension to that, the virtual brands. And I'm not going to spend a ton of time on this topic today, because we have a really great panel coming up later this week that specifically discusses this segment and how effectively and profitably it's been growing. But based solely on all these newspaper headlines, this concept has really grabbed our mutual attention, from consumers to operators, investors, and it doesn't seem ready to let go. So, what I will say though, Vince, is that in a really short story, I remember sitting on the stage at this event 3 years ago and talking about an article I read about a small burrito place in New York City that was doing burgers out their back door for delivery only. And and then talking about how that's a really great way to drive incremental business, and that gives you an idea for the context of the speed by which this concept has taken hold in the industry, and one that has been universally adopted, right, from full service to quick service, and even YouTubers and celebrities and backyard chefs. So to wrap up here, on the idea of eating at home, we can't forget about meal kits, and so Vince, what do we know about that segment?
Well, thanks for that, Jacob, and sorry for that little technical interruption earlier. So meal kit ordering online has flatlined at just about 20% of Canadian households this past year. Now, that is, like I said, about the same as it was in 2020, but it still remains up by about 8 points or 1/3 since 2019. And purchase intent remains very high. Just over 1/3 of households have purchased a meal kit online in the past, and about half of people do intend to purchase them in the future, in the coming months. So all of this means that the majority of households are still open to be convinced that this is a viable meal solution, and that many of them are really on the cusp of going ahead. It really is a trend that really has a good upside. And witness, for example, Good Food. So this is one of the few publicly traded companies in this space. And in the past 18 months, they've really expanded their offerings. They are offering groceries, for example, and many of them in the larger markets, they're offering same-day delivery of their kits. So since the pandemic, as a result, their stock price has tripled since pre-pandemic levels. Now, based on Jacob's story about the rise in family dining at home, you may be asking yourself if families are even bothering to visit restaurants together anymore. And the answer to this question is a resounding yes. Currently, 1 in 5 on-premises visits include a child under the age of 18, and this has been very consistent all through COVID and during this current recovery period, which also tells me that not only are families driving delivery and ordering trend, like Jacob and his family this evening, but also that families are excited to go out for the same reasons that adults like to go out on their own. They enjoy the experience of a restaurant meal, and they've all really missed it over the last 18 months. Which is exactly why my wife and I have returned to dining out quite extensively over the last number of months. And we're empty nesters, but that hasn't stopped us from visiting our favorite restaurants and seeing all those families there. And we're always trying out some of those new spots in our neighborhood. Now, as a result, on-premises visits are quickly returning to the market, validating again our studies from the last 12 months that told us how much people really missed dining in person in restaurants. Yes, volume for the summer of 2021 is still down about 50% where it was in 2019, but it has also doubled since last year. So showing very much a recovery there. Some of the key factors driving this upward trend are listed here. First of all, we have the FSR segment, which now represents about half of all on-premises visits, which is up 10 points since pre-COVID. Remember I told you earlier, the QSR, they've begun to recapture some of their lost on-premises visits, but people aren't necessarily eager to dine in at a fast food restaurant right now. And you'll also remember earlier I mentioned that some of them haven't even bothered opening up their dining rooms yet. Next, we have consumers under the age of 34, and they are becoming increasingly important for all on-premises occasions, and especially FSR. Again, just like they told us, this cohort has proven to be the quickest to return to restaurants, while older cohorts, well, they've been holding back a little bit longer for a number of reasons. And this represents a significant shift since older cohorts really represent the majority of spending in FSRs. Meanwhile, we see supper is proving to be the meal occasion where consumers are choosing to return to the market, just like me and my wife on this occasion here, while lunch remains the biggest day part for on-premises, and is gaining some of that normal activity share when we're out of the home shopping or working or whatever, running errands. But supper is where the on-premises recovery really is right now. And finally, this pandemic has been really difficult on the lower end of the economic spectrum. So it shouldn't come as any surprise that households with higher incomes have been the first to return to the luxury of on-premises restaurant meals. And like Jacob mentioned earlier off the top in his economic summary, well, it's these households that are really sitting on that additional disposable income because of the lack of other experiential spending opportunities this past 18 months. Now, part of every restaurant experience these days really is the safety consideration. The number one measure of the safety is vaccinations, which is a good thing since most of the population really is vaccinated right now. Regular cleaning, social distancing, physical barriers, masks and gloves, these are all part of the restaurant occasion that are making people feel safe and wanting to return. It's really interesting to note that vaccinated Canadians were planning to return to restaurants more slowly than the unvaccinated. Now, this study that I'm sharing with you here was taken before the concept of vaccine passports really took hold. Now, perhaps this program, now that it's been rolled out in pretty much every province across the country, is going to change things. But because it means that vaccinated Canadians may now feel safer coming back to restaurants. But of course, it also means that the non-vaccinated cannot dine in at restaurants. So it could be a wash in terms of the effect on business. It's a little soon for this trend to hit my CREST data, but I'm wondering, Jacob, what are you hearing from operators? What are you hearing on the street about this trend?
Yeah, well, that's actually it's interesting, Vince. When we talk to a lot of operators, when passports first started and first came out, I think just about everybody saw a pretty aggressive decline in traffic right off the bat, which does speak to this slide, right? And the comments around sort of the non-vaccinated diners. But it does seem like, fortunately, that most have since reported that this traffic has sort of slowly rebuilt itself, week after week, and for some of the provinces that have passports longer, it seems like they're close again to those sort of pre-levels.
Very, very true. That's great. Thanks for sharing that. And the other thing here is that the rules just keep on changing, as we saw in Ontario and BC last week. So it's all a work in progress, certainly. Now, another phenomenon that we've been following is the reasons why we choose our restaurant destinations when we do choose to go out. After so many months of lockdown, a return to restaurants is now more likely to be about treating ourselves, satisfying a craving, or just trying something new. Food exploration really is top of mind for so many, as we're tired of being cooped up at home and cooking for ourselves, using all those new kitchen gadgets I told you about earlier. Now, sure, we can order pretty much anything we want delivered to our door, like Jacob and his family does on a regular occasion. But when we do choose to go out, we want to explore. What's in decline in terms of driving us to restaurants? Well, one of them is loyalty. It's somewhat waning, especially for FSR restaurants. Convenience, well, it's not as important as it was prior because we're not going out as often. Therefore, we're more likely to go a little bit out of our way to get that special experience that we're looking for. And price isn't as important. You'll recall a few slides ago my discussion on higher income households. Connecting the dots on many of the above is actually the influence of those younger cohorts. Once again, they tend to be more adventurous, less loyal, and are always on the hunt for the next new restaurant. This under 35 crowd is truly going to be the future of FSR, only a little bit sooner than we expected. So ask yourself, are you ready for them? Now, as much as we continue to enjoy our return to restaurant visits, like I said earlier, it just doesn't quite feel the same as it was. If we were in a live environment, I suspect I'd be looking around and everybody would be nodding their heads right now. Some examples of that? Well, we're seeing smaller menus. Labor issues and fewer visitors are causing restaurants to remove complicated or slow-moving items from their menus. Simpler menus mean fewer ingredients needed, which means less opportunity for waste. Some menu items don't travel well and are eliminated from delivery menus, and operators, well, they'll often just remove them from the dining room menu as well as a result. We're all experiencing some slower service. Again, there is some difficulty in the industry, as we've heard, about recruiting workers, but there's also difficulty in serving, as restaurant staff must also adhere to distancing guidelines in their workplace. We're not allowed to linger as long as we used to in restaurants, I'm finding. If the restaurant is lucky enough to have people waiting to be seated, they're eager to get them into the seats as quickly as possible, especially if they're operating at reduced limited capacity. Or they've reduced their hours. And so there's no opportunity for you to sit around with that dinner party that you haven't seen for a long time and order a second or third round or some extra dessert because the restaurant is closing early tonight. And then finally, there's that 800-pound gorilla in the room. Are prices going up? Things seem to be a little bit more expensive. And the answer to that is probably, maybe, but menu prices are not going up, at least according to our data, quite as much as consumer perception and media seem to be reporting. Instead, a lot of the increased spending that we're tracking in our CREST database is related to changes in consumer behavior and not necessarily in restaurant and menu pricing. So here is the list of some of the factors that we've really touched on a lot of these already today. We got shifting day parts, shifting access modes, increases in digital ordering, shifting need states, fewer habitual visits. Now, some of these will result in increased spending per visit. Others will result in decreased spending per visit. And some, like dealing, well, that could affect spending in both ways, believe it or not. So when we review spending on like-for-like occasions over the last 2 years, we're really finding that On average, spending is up only about 2 to 4%, which really is in line with historical trends. Now, for a little bit more on pricing influences, I'm going to turn it over to my partner, Jacob.
Well, thanks, Vincent. And that's actually interesting commentary, right? Because what we're seeing is that consumer habits have really changed with respect to what they're looking for in an on-premise experience, and their spending habits have equally adjusted and perhaps have created this illusion of increased menu pricing. But I think real pricing jumps are going to become a reality in the very, very near future. Given what's happening with inflation and just the cost of doing business in general. Labor, as you mentioned, and certainly something we're going to touch on later this week in another panel, is a well-established issue, but it's also become painfully obvious that we're seeing problems up and down the supply chain. Food and alcohol shortages have been, consistent challenges throughout this pandemic, and I think are going to continue to be that, at least for the short term. But there are longer term issues out there, things related to material shortages and equipment delivery and import delays that have put this whole industry in a bind. One of the interesting examples that I came across, at last count, there's something like 100 plus container ships anchored outside the two largest U.S. ports, waiting to unload. And in a pre-pandemic environment, 4 or 5 would have been considered a backlog. So not only you have that, but then on top of it, you've got a shortage of truck drivers, you have gas prices that are really high, and all that's led to a cost of shipping and freight that's up over 800%. So all these things combined, it makes for things like steel and equipment, it makes them incredibly expensive, really hard to find, and when you do, there's upwards of a 12-month backlog, which really puts new construction and renovation at risk. And unfortunately, based on everything I've read and seen and people that you talk to, this stuff is probably not going to be resolved until 2023 at the earliest.
Well, thanks for all that, Jacob. It looks like, yes, we're going to be hearing about pricing for quite some time to come. Yeah. Now, I just wanted to share with you one final restaurant trend that I'm seeing or that I'm experiencing. To me, I think that staying in is going to be the new going out, despite the fact that I do like to go out a lot to restaurants. Now, we know that an important night out with friends and family is sometimes, it's possible to bring that restaurant experience home now. And I'm not just talking about the food. Restaurants have been reinventing themselves into virtual entertainment hosts over the last 2 years. Before the pandemic, I used to encourage restaurant operators to really create those experiences for their guests who do come out to visit, because a night out can be so much more than just a meal. Now we're seeing those restaurants bringing those experiences right into people's homes. So some examples of these entertainment experiences. Well, I know some coworkers, for example, who enjoy taking part in Hot Ones chicken wing competitions at home. They buy the kits from their local restaurants and share virtually with their friends online. I've attended some virtual fundraising events that are hosted by local restaurants on behalf of local charities. I've enjoyed beverage alcohol kits that are hosted by mixologists, brewmasters, and sommeliers, again, all online. And we've seen meal kits that are hosted by chefs and local restaurants. All of these opportunities to engage with local restaurants while in the comfort of our own home. And now maybe for some, a night in is something as simple as ordering our favorite movie popcorn delivered right to our door in time to stream the latest new release on our new big screen TV. Or if you got those late night snack cravings, you can just order up your favorite snacks from 7-Eleven or directly from the Skip the Dishes fulfillment centers in some of their local markets. Just another example of how that aggregator model that you were speaking of earlier, Jacob, is evolving. And we're all being encouraged to stay home more than ever.
Yeah, Vince, I mean, I agree with you on a lot of things, but on this particular topic, I do have to disagree, because I think that going out is going to be and is the new going out. Like you talked about before, I mean, prior to the pandemic, that entertainment category was one of the fastest growing, most creative and engaging sort of subsegments of this industry. And certainly concepts have had to adjust. But I don't think people have thrown in the towel on premise, experience and entertainment. And going back to what you talked about before, I think the key to making this work and driving people back to restaurants is that experiential factor. Patios, for example, have played a real role here, I think, especially with our newfound love of outdoor space. And that could be something like stealing ideas like a trivia or music night from brewery, or maybe something like a sports or games right out of your own backyard, and putting that all on the patio. Or conversely, it might just be investing in the space to create a real beautiful, warm, inviting, but energetic kind of seated experience. And in all ways, I mean, patios, I really think, have become sort of the heart of a restaurant. Another good example, too, Vince, of I think how experience will help in the recovery is how operators have really weaved interaction and theater into their business models. And chef tables are an example. There was a time when that chef table offered a bit of an interactive experience to a very select few, and now we're starting to see this idea showing up on a broader scale. Open kitchens or just more centralized kitchens that are surrounded by bar and table seating that provides an immersive experience for everybody in the space. And also, it's not just full service either that's doing this. I was reading recently about Panera and their restaurant of the future, which includes in part moving their ovens and their baking equipment to the front of the restaurant, so that that on-premise consumer can really still engage with and relate to the process of making the bread. So, Vince, this all brings us back to where we started and the idea of a new normal. Where is it? When is it going to get here? And what is it going to look like when it does?
Well, Jacob, I am glad you asked. So what we did here at NPD is we asked some of the brightest minds that we have in our analytics team to tackle that exact question. And they have assembled for us a comprehensive outlook of the food service industry. They're capturing more than 60 different segment and menu occasions and provided predictions and their outlook to 2023. Now, the result, we are predicting a positive but somewhat muted recovery to continue in the restaurant traffic space. By the end of 2022, we're forecasting that traffic will remain still below 2019 levels at -6% overall. Remember, COVID-19 wiped out more than a decade's worth of growth in just a matter of months, and now we're expecting it's going to take up to 3 years to get back to pre-pandemic levels. Now, some areas are going to be recovering faster than others. QSR, as I mentioned earlier, is bouncing back a little bit quicker than FSR. Digital ordering is expected to continue its growth curve. And turning to menu items, burgers, pizza, and the omnipresent chicken sandwich wars remain in growth mode. While brewed coffee, well, we know that's going to continue to struggle a little bit. And here's another of those positive trends, delivery. This goes hand in hand with the digital ordering that we've already spoken about. Now, delivery grew exponentially in 2020 and helped to sustain many segments of the industry. While absolute volumes have begun to decline now that restaurants are reopening, we are expecting an upward curve to resume, and volumes are expected to remain well above historical levels into the future. As new delivery models are introduced, this segment of the market is only going to continue to evolve and grow. We've all had 18 months to get used to this new habit of restaurant delivery, and it's more than enough time for this behavior to become sticky in the minds of Canadian consumers.
Yeah. That's totally true, Vince. Even those in the industry that I don't think believed 6 months ago in this concept are really now jumping on the bandwagon, right? And I remember Darden, back in January, sort of publicly questioned the stickiness of digital and off-premise, but I think have since then really adopted it, and recently spoke out about how it's a relevant and important piece of their revenue mix going forward. So everyone's really coming around on this concept.
Couldn't agree more, Jacob.
Yeah.
So summing up for the day, what have we learned from our virtual selves here today?
Well, I hope our younger, cooler selves taught us all a few lessons, and a couple of highlights for me at least. One is seeing a return to some of our former routines or older routines that have really started to bring daytime traffic back to restaurants. Digital ordering, which has grown like crazy, I think definitely is a trend that's here to stay. The real estate market has been static, and I think it's a little unclear how it's going to evolve, but I'm fairly confident that there's going to be a lot more M&A and consolidation coming in this segment. And finally, for me, how important family dining has been, both on and off premise for this industry over the last 18 months.
And yeah, for me, Jacob, some of the things that I've learned, well, continued work from home activity is really going to hamper the overall restaurant industry recovery in the foreseeable future. Meanwhile, we see independents and small chains are coming back stronger than ever and are going to help drive the future forward. On-premises visits are returning, but still trail pre-pandemic penetration levels, so there's a lot of recovery still there to come. And finally, younger cohorts are helping to redefine many aspects of the industry, only maybe a little bit sooner than we had expected a few years ago.
Yeah, no, for sure. And so, Vince, to close off today, we learned our lesson last year, right? We're not going to make that same mistake and try to predict a new normal. But we do have some observations on this, and this is an industry that's still very much in recovery, and it's obviously one that is not where we thought it was going to be at this stage. But things are evolving, and the way that people adapt and change their behaviors are really going to define, I think, what this industry looks like going forward, right? Because there are some of our old behaviors are going to come back, but some of the new stuff is going to stick, and how all that comes together. And most importantly, how operators respond to that, I think, are going to determine success in the future. And I'll close off by saying, this is a question that hopefully we're going to have a lot more clarity on next year, and we are going to do this again, and hopefully do it live. And I think we'll learn a lot between now and then. So, anyways, that's it for us, Vince. Again, I thank you for jumping on this year and all the tremendous insights. And I want to thank everyone for listening today and participating. And I look forward to seeing you all in person next year. So thanks, Vince.
Thanks, Jacob.
And Dimitri, back to you.
Perfect. Thanks, Jacob and Vince. Another stellar food service State of the Nation for a seventh year straight. So I'm sure everybody appreciates the relevant commentary and the feedback into the current restaurant landscape here in Canada, especially as the industry navigates and resurface through the motions of what is a global pandemic. So thanks again. Before we close out today's session, just a quick couple of reminders. The roundtable discussions is taking place in the networking area directly after this session. Again, there's a cap of 25 people per session, so if the spots are full, we'll be hosting the same roundtables again tomorrow after the CEO panel discussion, so join us then. We also, again, encourage you to visit the exhibit hall and check out the sponsor partner profiles, as well as connect with the other fellow attendees in the networking area. And lastly, given the presentation concluded today, there remains 5 more sessions this week, kicking off again at 1 p.m. Eastern Time daily. So I look forward to seeing you all back here tomorrow. So one more time, thank you again to Jacob and Vince for presenting today and providing your insights. Thank you to our sponsors, and most importantly, thank you, our audience, for joining us today. Have a great rest of your day, and we'll see you tomorrow.